Welcome to this Handtech Markets video on Bollinger Bands. Since their introduction by John Bollinger in the 1980s, Bollinger Bands have grown in popularity to become one of the most widely used tools of technical analysis. They are included as a part of the default setup in nearly all modern charting packages, including the one that is part of your MT4 trading platform. As you can see on this chart, Bollinger Bands consist of three lines. The center line is in fact just a simple moving average. Another band is plotted on each side of the moving average, creating the upper and lower Bollinger Bands. The distance between the center line and the upper and lower bands changes in line with the changing volatility of the underlying instrument. When the volatility is high, the bands are further apart, and when the volatility is low, the bands draw together. The beauty of Bollinger Bands over other envelope type indicators is that they adjust automatically to market conditions. Now let's have a look at how to put them on a chart. Once you've selected the chart that you want to use, there are a number of different ways to add the Bollinger Bands. The simplest is to come up to the top of the screen and click on the Indicators icon. If you've recently applied the Bollinger Band indicator to another chart, it should appear in this upper list here. If not, never mind, just come down to the Trend grouping, open that one up, and you'll find the Bollinger Bands indicator in there. The other option is to go to the Navigator window over on the left-hand side, click on the Indicators folder, and when that opens up, scroll down until you find the Bollinger Bands. Now from here you have three choices. You can double-click on the name of the indicator to apply it to the open chart. You can right-click on the name and then select Attach to Chart, or you can simply drag it and drop it onto the chart. All three methods result in the same outcome, the appearance of a box that allows you to adjust the Bollinger Band parameters. By default, Bollinger Bands are usually set with a 20-period moving average, which is a simple moving average, and two standard deviations. A standard deviation is just a statistical measure of volatility. In this window you also have the ability to shift the indicator forward or backwards in time, and if you wish to, you can experiment with applying the indicator to data points other than the close. At the bottom of this window you can change the color of the indicator as well as changing the line style and the weight. Once you're happy with the parameters, click OK and the Bollinger Bands will appear on your chart. Now on this Eurodollar chart you can see clearly how the Bollinger Bands expand and contract in line with the volatility of the underlying market. You can also see a couple of examples of what John Bollinger calls the squeeze. This is a period in time when the volatility is relatively low and the bands squeeze together. Because volatility tends to cycle between low volatility and high volatility, there is a good chance that a period of particularly low volatility will be closely followed by a period of significantly higher volatility. In other words, when you see the Bollinger Bands squeeze together, there is a high probability that prices will soon break out in one direction or the other. The Bollinger Bands on their own won't tell you which way prices are likely to break out, but other tools can help you with this. If you're unable to decide which way prices will break out, you can straddle the market by placing a buy order just above the range and placing a sell order just below the range. While the squeeze is one of the most easily recognized and widely used features of Bollinger Bands, this tool provides numerous other useful signals. As you can see, when prices break out from a squeeze, there is often an impulsive move in price. Because of the way the standard deviations are calculated, the sudden move in prices away from the moving average results in a rapid increase in the value of the standard deviations. This in turn means that both the upper and lower Bollinger Bands are plotted at a greater distance from the moving average. When prices move rapidly enough after a period of consolidation, a bubble appears in the Bollinger Bands, as you can see here and here. When the bubble starts contracting as the band that initially moved away from the price action turns back towards the moving average and prices, it's a good indication that the initial impulsive move is coming to an end. It doesn't necessarily mean that prices will reverse direction. It may just be that the impulsive move pauses for consolidation before prices continue in the same direction. Either way, if you've been fortunate enough to establish a position that has benefited from the breakout and the impulsive move in prices, signs of a contraction in the bubble, when this band turns back towards price action, should be taken as a signal to either take some profits or tighten up stops. On the other hand, if you're late to the party and have been considering opening a new trade in the direction of the impulsive move, a contraction in the bubble should be taken as a sign to hold back, as that initial impulsive move is likely to be coming to an end. There is another feature visible on this chart that Bollinger calls walking the bands. As you can see, during this phase of the market action, prices were contained between the upper Bollinger Band and the moving average. If we switch to another period in time, we can see on this chart both bullish and bearish phases of walking the bands. Here's a bullish phase, and over here we have a bearish phase. This clearly demonstrates a point that Bollinger states clearly in his book Bollinger on Bollinger Bands, and this is that a tag of the upper band is not a signal to sell, and a tag of the lower band is not a signal to buy. It should be clear that if you bought the market every time prices hit the lower band, your performance would have been very poor during this bearish phase of activity. Similarly, if you sold the market every time prices hit the upper band, that wouldn't work out too well either. Unfortunately, this is a common mistake made by novice traders. As with any tool of technical analysis, you should experiment with Bollinger Bands yourself before attempting to use them to make trading decisions on a live account. Good luck.